Well, hello and welcome to Thank God It's Friday as we head into the new year and try to understand how markets will behave to be able to take investment decisions. It is also important to reflect on the year that has gone by, and for that we have here with us Amay Hattangadi and Swanand Kelkar from Morgan Stanley Investment to share their learnings from 2016. Amay, betting on events is one of the learnings that you have spoken about, and that is of course on the backdrop of how pollsters have really got it entirely wrong with betting on event outcomes. Now, some of the markets experts do believe that there is absolutely no use in trying to, worry about what the Fed will do, what the RBI will do, or what the next quarter earnings are going to be like, because they attribute zero value to it from a fundamental perspective. Most of them believe that you should, the only way to make money in the equity market is to buy fundamental quality stocks and then hold on to it. What I want to understand from you is, how do you deal with all this market noise? Do you look at it as an opportunity to play tactically, or it does not really impact your portfolio allocations?
Well, Shraddha, thanks Shraddha, thanks Agam for having us on the show. I think it's aptly called Thank God It's Friday, but even more so, thank God it's the last trading day of the year, because it's been a very eventful year.
Totally.
A lot of unpredictable events happened this year. And like you're very correctly saying, that trying to predict events has been the biggest fallacy of 2016, because time and again the pollsters have gone wrong in trying to predict very big events, whether it was the US presidential election, whether it was Brexit. So clearly predicting events has it's not been the best of years for predicting events. And it's been even not just for predicting events, but trying to predict what the market outcome of that event is going to be was even more unpredictable, right? So even if you got the event right, you probably did not get the way the markets would react to that event.
Right.
So having spoken so much about events, I think it's very natural to now look forward into 2017 and say, what are the big events out there, right? And I've seen so many people enlist some of those events, whether it is elections in UP, Punjab, whether it is GST, whether it's what will happen in the budget. But I think this is very normal, behavior, right? We seek out events because we want to anchor ourselves to an event.
Correct.
And I think the learning of 2016 is really that we should not anchor ourselves to outcome of events. So I would actually want to stay away from trying to predict or even trying to anchor a market outcome for these events, right? So I think we'll have to take 2017 as it comes, and not try to lay too much emphasis on very specific events. I think that's the learning from 2016 really, which I think we have to go into 2017 trying not to say that what's going to happen for each of these events.
Right. Okay, so you all are completely unmoved, or rather your portfolio allocations based on all this market noise.
No, I'm saying these events create noise, and trying to readjust the portfolio for every event. There's an event happening practically every day, every week. There's something or the other, right? Either there'll be something that the Fed is going to do, there may be new leaders getting appointed in China during the year. There could be, I guess, the French elections. So there's so many events out there, right, internationally, and then locally there are so many events.
Right.
So trying to, getting too caught up in these events is quite, and because as we saw in 2016 as well, right, nobody thought November 8th was a big event for India, right, because that was not on our calendar.
Right.
We unfortunately keep looking forward to events which are already on our calendar, and sometimes the biggest moves in the market could happen from events which are not on your calendar.
Fair.
So, well, that's actually where I'm headed next. And Swanand, I want to ask you, so we're all waiting for more crucial data to come out of the demonetization scheme. And in your report, I noticed that you mentioned that demonetization will not be a non-event that the current forecasts seem to indicate. And as you also mentioned, that there hasn't been too much of a change in forecasts so far. What are the few variables that you guys are keeping an eye on with respect to demonetization as we move into January?
Exactly. I think that's a great way of looking at it, because as we were discussing this, a lot of people have formed their views about demonetization and whether it's working or not based on anecdotes. We haven't really seen hard data as yet. That's because the first month after demonetization would be December, and we'll see December data start trickling in from January.
Right.
November wasn't a clean month because you had the first 8 days where Diwali spillovers and things like that. But turning to expectations, what's happened is before demonetization, the Sensex earnings growth expectation for FY17 was about 13%. And for FY18, people expected about 18% growth from earnings. That is before the demonetization even. If I see 2 months later, almost 50-55 days, it's now just 13's gone down to 11 and 18's inched up to 19.
Right.
People haven't really changed their numbers. And I don't blame people for that because this is an unprecedented event. We don't have a template to analyze this event with.
Right.
Right.
That's why we don't really know what the earnings impact will be. What we are pretty sure of, talking to people, talking to some of our portfolio companies, talking to some of the other channel partners, etc., is it's not going to be the non-event that the consensus forecasts tell us.
Right.
I think growth is going to be weaker than what most of the consensus forecasts estimate. There will be pockets of strength. There will be some sectors, some stocks which might just be totally unaffected by all this. But it's not going to be a business as usual type. Market's going to forget this event in a month or so and not bother about it at all.
Right.
This is a big event. This to me is a growth shock. I think growth is going to be lower than what people expect, not just for 1 or 2 quarters, but maybe longer.
Right.
And today I cannot quantify it. I think nobody can. The way we are going to play it is we are going to play it by the year. We
Right.
are going to wait for high frequency data. Let's say auto numbers come out early January.
Right.
You will get to see quarterly results from some of the companies and commentaries, etc. For instance, in asset quality, in something like that, given the RBI dispensation, the real picture might come out 6 months later.
Right.
Right, when you have the moratorium and then you have the
Right,
asset quality
right.
issues. So I think it's foolhardy to sit here and take a view. I think it's an unprecedented event. We don't have a template to analyze this with because it has never happened, I think, even in any country with such benign economic backdrop. So we'll have to play it by the year. It's unfortunate. I can't give you a very precise answer.
Right.
But that's the reality.
Right. So, Amay, he just spoke about asset quality right now, and we had the RBI just very recently speak about a possibility of bad loans for the entire banking system to move up by as much as 10%. And I know that you guys are overweight on financials. Based on that, what is your view and how would you go about it? Would you just have the same view for now and wait for more data to come in?
Well, I think our overweight on financials comes primarily from those companies that are focused on the consumer lending side of the business. And as you know that a bulk of the NPLs is primarily on the project finance related corporate side of the book. So that's a clarification before I take your question further.
Okay.
I think the demonetization, like Swanand mentioned, is going to have a very asymmetric impact on the economy on different sectors. So how it's going to further impact the NPL cycle is difficult to predict at this point of time.
Right.
The question really in front of everybody is whether what we are seeing on the project finance side, does that spill over further into the SME segments as a result of demonetization, and that really depends on how prolonged the slump is going to be, the growth impact is going to be, and whether the economy picks up fast enough.
Right.
So I think it's very difficult now to predict the NPL cycle and what's going to happen beyond the project finance, which is where most of the NPLs have so far been concentrated.
Right.
Okay, so you're overweight on consumer discretionary but underweight on consumer staples. So just want to understand what is so appealing about the discretionary space and what is not appealing about staples then?
So staples was primarily a valuations call. So
Okay.
If you looked at the consumer staples universe today, it was trading at an average PE of 35 times FY18. The first half of the year, if you look at the volume growth for the consumer staples companies, it was barely 2 or 3%. I mean, the leading consumer company reported a negative volume growth number in the second quarter. So when you put this kind of growth with that kind of valuation, it's really difficult to have these things in the portfolio and expect positive absolute return from nothing. So they're great companies, great franchises, but we also look at valuations. We look at making money from an 18 to 24 month standpoint. So that's where consumer staples was an underweight. The other issue we felt that for the past 18 to 24 months, the commodity tailwinds that the consumer staples sector witnessed or that took advantage of, that is abating.
Right.
That's no longer as strong a tailwind as it was, let's say, 12, 24 months ago. On the consumer discretionary side, we primarily have stocks in media and the automobile sector. Even there, although valuations had stretched, we felt that the growth valuation matrix was still a lot more favorable than it was at the consumer staples companies. Also, falling interest rates benefit the consumer discretionary space more than they do on the consumer staples side. But again, these are portfolios in flux. I think no portfolio manager today will come here and tell you that I'm absolutely sure that I'm running with the right portfolio right now.
True.
Because we are in uncharted territory. So I think we need to have the humility to understand that these are portfolios in flux.
Right.
Maybe consumer staples might weather this storm better than the consumer discretionary space. And if that is borne out by high frequency data, I don't think we'll hesitate to change our portfolio orientations.
Okay, Amay, my question is to you. Again, you all have spoken about staying close to the metrics, where you've said that it's important to keep your ears to the ground and focus not only on the broad macros, but also try to get into a micro perspective. But execution, order book and margin challenges continue to remain for industrials, but you're overweight on it. So what are your thoughts as far as industrials are concerned?
Well, industrials is a very broad sector. The engineering segment is just one part of industrials. What we like in industrials is really the transport-related segments, right? So there are stocks in the commercial vehicle segment, for example, where there was an improvement in the movement of goods across the country. There was an uptick from what was a very deep cycle. So we like the transportation side of the industrial segment. You're quite right in your observation on the engineering side of the business, where the order books have grown, but the execution has not really kept pace.
Right.
And I think over there we have to really wait and see how good the execution is, because clearly most of the capex is being done now by the government, because the private sector is still in wait and watch mode. They have surplus capacity in most segments. So it is really now up to the government, and I think the segments that are the flag bearers or the leaders there are going to be the roads and railway segment, where we have to see how good the execution is going to be. So I think you're right in your observation there. You know, the order books have bloated, but the execution has not kept pace, and we now need to see how quickly they execute on particularly road railway projects, defense ordering, and so on and so forth.
So mainly the roads and transportation subsector and not the engineering ones.
Yeah.
All right. So, Swanand, over the past few years, the influence of the union budget hasn't been so much when it comes to moving equity markets. But some also suggest that this one is going to be a little different. So what are your expectations? What would you be looking for from the union budget, considering we're just a month away from that event?
So just to play a bit of devil's advocate there, if you thought of 2015 budget, Nifty peaked on budget day,
Right.
9100.
Yes.
If you looked at
Yes.
the 2016 budget, the Nifty bottomed
Yeah.
Right.
at 6800 on
Right.
intraday on the budget day. So yeah, there is some, it might be coincidental, so
Right,
just two data
right.
points. But I think there are a lot of expectations from this budget. The primary expectations are that some pain alleviation will come through.
Right.
I don't know in what form or shape it comes. There's a clamor for reduction of corporate tax rates. There's clamor for some sort of a rural support because demonetization has hit that part of the economy a bit hard. I think balancing all this with the fiscal math is going to be challenging. I think we have a 3% FRBM target for FY18.
Right.
I don't know if that will be met per se. I don't think markets are going to take it very badly if the FRBM target is not met. But I think we need to see tax to GDP numbers go up. If you ask me over the next 1, 2 or 3 years, what is the one number I watch for to check if demonetization has been a successful exercise or no?
Right.
It's going to be the tax to GDP number, because that number for India has been stuck in a rut for the longest time. I mean,
Right.
the two macro numbers for India which have been stuck in the same band for the longest time is one is tax to GDP and the other is manufacturing to GDP. I think both these numbers are something that we need to watch out for the next few years. So I think the IDS schemes, how much they can mop up, Will it be a sustainable bump up to tax to GDP, or is it just a one-off which just pulls up the number for a year and then things peter out again? I think those are the things we need to watch from the budget. The budget math, what kind of pain alleviation happens in terms of both the corporate as well as the rural sector. Those are the few things we'll watch from this budget.
Okay.
Do you think this move or the shift of all your foreign funds back to the US will continue to hurt emerging markets in 2017 as well?
So again, emerging markets, we are not experts, we are India portfolio managers, but we plug into our team which does a lot of analysis on these things. So just if you look at it from first principles basis, right? I mean, the dollar is at a fairly strong level, like the strongest levels in many years. So a strong dollar, commodities which have peaked or are peaking are coming off. The prospect of further rate increases in the US bond yields looking up, probably corporate tax rates in the US going down significantly if what Mr. Trump promises comes through. I think in all this backdrop, it's going to be rowing upstream for EMs. So EMs, it's difficult for EMs in an environment of dollar strength, commodity prices not doing too much, US rates going up. So I think EMs will not have a banner year. EMs had a good year this year. They'll probably end up with 8-9% dollar returns. I think we'll have to be a bit more careful about EMs as an asset class for next year.
Right.
Okay, so Amay, based on the baggage, based on the economic baggage that we're carrying forward in 2017 and some possible positives too, what are Indian equity markets looking like in the year ahead?
So I think this is a continuous feedback loop that we're going to see next year, as is the case every time, right? So you have the economy, you have markets giving a feedback into government and regulators, which is the RBI. And I think through the year we'll have to keep watching how this feedback loop works, right? Because the budget, like Swanand mentioned, will try to alleviate some of the pain through some fiscal stimulus measures, but then this has been such a shock in the economy and different segments have been affected differently. It is almost impossible to have measures that do give the exact cure for pain in each of these segments as is required, right? So there will be some segments which where the stimulus will work better. There will be some segments which will probably cry out for pain 6 months after the budget, and something may need to be done there. So I think there's going to be this constant feedback loop, and I think the markets will see gyrations as the economy and the government responds to the signals from the economy and the market. So I think it's extremely difficult to try to predict how this is going to play out, but I think it's going to be a very eventful year with a constant feedback loop. And I think even after demonetization, we've seen that the government has through various notifications tried to respond, and I think we'll probably see something similar in 2017 as well, depending on how the economy and markets react. That you may see steps being taken through the year. So like I said again, it's not just first Feb that we need to look out for. It's going to be a constant feedback loop through the year.
Right. Okay, so we're coming down to a relatively easier part of our conversation now, and I've noticed this really cool quote that these guys have in their report, and this is by psychologist Amos Tversky. I hope I'm getting the pronunciation right. And he puts it, the secret to doing good research is always to be a little underemployed. You waste years by not being able to waste hours. And I'm sure this should be a reminder to all of us from time to time. But I'm going to ask both of you to explain a little more behind the thought behind this quote.
Sure. So let me start, and then probably Amay can add to it. So the market is a very fascinating thing, right? I mean, all of us are so obsessed with markets. I mean, I have seen people who at 9:15 their behavior changes because they know that the markets have opened, and they're refreshing their handheld screens and trying to see where the market has opened, etc. We get really consumed by this animal, right? We are not able to take a step back, and we are just jumping from one news item to the other, or one stock price, one ticker to the other. We really don't get the time to kind of have a sense of detachment. I was joking with Amay the other day. She was just young and had just gotten married. So somebody asked me, how long have you been married? And I said 7 quarters. It was then that I realized that I'm just too deep into this, and I'm measuring time in quarters. So that is when, not exactly then, but I think you need to cultivate a sense of detachment. You need to take a step back.
Yeah.
It sometimes markets feel like a Hindi soap opera, and even if you switch on the serial like after 6, 7, 8 episodes, you haven't missed anything. It's just
Right.
that you feel compulsively, you feel like watching it every day,
Yeah.
but actually nothing's happening if you take a step back and come back to it maybe after 6 or 7 episodes. So I think develop that healthy sense of detachment, have a passion, have a hobby, spend some time doing that. It will make you a better investor. That's what we feel.
Yeah.
Amay, you?
Well, psychologists have done work. In fact, Amos Tversky and Daniel Kahneman have done work, and this is quoted in Nassim Nicholas Taleb's first book, Fooled by Randomness, as well.
Okay, yeah.
Which is that the pain that we suffer from a loss is twice the happiness that we get
That
from
we
a
get from
gain.
True.
Right? And what Taleb says in his book is that if you're going to stare at the screen all day long, and let's say you have an equal number of upticks and equal number of downticks in the
downticks.
stock price, you will still end up being unhappy because the
Unhappy,
pain
right.
from the loss is twice that
Twice
of the
that
gain.
of the
Right?
gain,
So,
right,
so
yeah.
you need twice the number of upticks
Right.
if you're going to keep looking at the screen all day long versus downticks
Right.
to end the day neutral. Right? So the less frequently you see the screen, the better it's for your health and actually better it is for your portfolio.
That's fantastic.
I know, and with that, we're done with our market talk. So I'm going to ask you first, Amay. Let's talk about your bucket list for 2017.
Bucket list for 2017.
Yes, that's
What
also
are you
something
going to
that
try
you've
and tick
written
off
about.
the bucket list for 2017?
Something that you're really looking forward to do this year.
No, I think I haven't yet crystallized my resolutions for 2017.
Yeah.
Okay.
But I clearly think I think we have to look for the learnings of 2016, look back at the learnings of 2016, and just get out of this habit of what I mentioned at the beginning, being obsessed about events.
Right.
I think that is to me very important. And I think that itself will free up a lot of time and mind space to do better reading, better research, and I think that is very important because it's very easy to fill up your day with meetings, with trying to discuss events, which often you realize once the event passes by that it's had very little bearing on your investment or on your portfolio.
Right. Well,
Swanand, anything on your travel list or any hobby that you want to
This is
sort
a
of catch?
perennial bucket list for me. I want to lose 2 kgs. at any point.
That's a very big target.
Exactly. So no, I'm going to be seriously. I'm going to work a bit more on my fitness.
Okay.
I am going to make that part a non-negotiable part of the day. I mean, that is always sometimes what I have understood is fitness becomes a residual part of what you do. So you pay attention to fitness only after everything else is done. So that's definitely going to it's going to move up the priority list for sure.
Okay.
The other thing, I'm ashamed of saying this on live TV, but I can't swim, and I see 5-year-olds frolicking in the pool, and I just feel totally embarrassed about it. I'm going to learn swimming this year.
Okay.
Right.
Wow.
So just for making it on record, do you want to resolve? Are you saying that you were resolved to take these things forward?
Yeah, I mean, 31st December 2017, we'll do this poolside.
Excellent. Excellent. Yes, we really hope something like that can happen. Absolutely. Yeah. And what about you? Are you resolving for the new year? Do you have any resolutions for the new year?
No, just continue doing the same.
Shraddha, you?
I will take every day as it comes. I have no resolution.
Well, I guess my resolution is to put up one quote every day on social media. Yeah, that will be my
Okay.
resolution.
Or you want
That's
to
good.
get more active on social media?
Yes,
Do you
at least
want
a quote.
Yeah, do you want to plug
something
your
like
Twitter
that.
handle here so that people can follow you?
Oh yeah.
I guess that
That
will
would be a good
perfect,
idea.
yeah.
Great.
Anyways, thanks guys, and I want to also
you.
wish both of you a happy new year and prosperous one as well.
Wish you the same.
And as for you guys too, I wish you guys and all of us here at Bloomberg Quint wish you a happy new year. And do stay tuned in, and we will see you in the new year. Goodbye.